name is Sandra D, and this is Ready, Action, a show about acting for income and entertainment. Thank you for tuning in today to learn more about how to become an actor. Today's episode covers the 7th part of a 10-part series covering the steps that you must take to start and move along in your acting career. Today, we'll talk more about your business plan and one of the 3 components called the income statement, which once again you must include on your business or career plan. Now there are 3 interlinking financial statements. 1 is the cash flow statement, 2 the income statement, and 3 the balance sheet. Just like any other business. That is, if you're taking your acting as a business. Today we'll talk about the income statement. The income statement is a simple and straightforward report on the proposed business's cash generating ability. It's like a scorecard on your financial performance of your business. It reflects when sales are made and when expenses are incurred. As an actor, sales come from many varieties of work that you do in your performance, such as theater, television, radio, print, and that could be on your face, your body, your voice, any form of acting and modeling. The income statement draws information from revenue, expenses, capital in the form of depreciation, and cost of goods. Let me break this down just a little bit for you. The income statement illustrates just how much you and your business makes or loses during the year by subtracting the cost of goods and expenses from your revenue. And this helps you to arrive at your net profit or loss. Okay, to arrive at a net result about your income, you're going to take your profit or loss, which is your revenue, that's your incoming money. You'll subtract your cost of goods and expenses, and that will give you your profit or loss. And that is what you're reporting on your tax forms. I mention financial data at this point of this entire series because financial data is always at the back of your business plan. Just like any other business, actors can look for investors, and investors will take a look at your charts and tables and your formulas and your spreadsheets, and they'll look at all of this information in your financial section because they know that this information tells whether or not you are an active actor and have a plan for future gain. So that's why this is so important for, actors to have. If this is your first year in business, your income statement is generated on a monthly basis, quarterly for the second, and annual for each year thereafter. It's formed by listing your financial projections in the following manner. Your projections are going to include income. It includes all income generated by the business and its sources. That includes all of the jobs that you're paid for during the year. Then it's going to include cost of goods. It includes the cost related to the sale of your product, your inventory. For example, if you have books or screenplays, if you've got a perfume line or clothing line as a part of your business, all of that information would be mentioned here. And this would talk about the cost related to the sale of those products. Then you have gross profit, a gross profit margin. That is the difference between the revenue and the cost of goods. Gross profit margin can be expressed in dollars, percentage, or both. Then we have operating expenses, and this includes all of your overhead and labor expenses associated with the operations of your business. Then you're going to include total expenses, which is the sum of all overhead and labor expenses required to operate your business. Then you have the net profit, and this is the difference between the gross profit margin and the total expenses. The net income depicts the business debt and the capital capabilities. Then you have depreciation, which reflects the decrease in value of capital assets used to generate income. This is also used as a basis for your tax deduction and an indicator of the flow of money into the new capital. Then you have new profit before interest, and that is the difference between net profit and depreciation. Then on the list you should have your interest, and the interest includes all interest derived from debts, both short-term and long-term, and the interest is determined by the amount of investment within the company. I know it's a lot of information, but let's keep going. Then you have net profit before taxes, and that is the difference between the net profit before interest. Then finally we have taxes, and that includes all taxes on the business. Oh, one more. Then you have profit after taxes, which is the difference between the profit before taxes and the taxes accrued. Profit after taxes is the bottom line for any company. If you handle your own taxes, you must understand this information and report it accordingly. If you have someone else doing your taxes, believe it or not, you still have to understand this because you are ultimately responsible for your taxes and your business. Have you ever been audited? You're the one that they will come after. Well, they will see if you had a tax guy, but if there's a big problem with it, guess who's paying? Not the tax guy. So it's important that you understand this information. Thank you for joining me once again. We have more information coming. This is Sandra D, and this is Ready